All right. Good morning, everybody. Japan is down 5%. This beatdown is just getting worse and worse. And the threat of intervention here continues to rise. It's hard to say that this is a brick in the wall of worry when the situation is becoming an entire wall all on its own. It's completely overlooked. Most places aren't even focused on this at all, but take a look at US dollar Japan and consider 2 decades of policy getting taken out and the unprecedented moves that we've been seeing. US dollar Japan is certainly something to keep your eye on. But for this morning, down another 5%. Hong Kong flipping back and forth between positive and negative, basically flat. Then the US markets kind of holding it on the low end, positive around 0.5%. And Europe, which is going to have data revisions, doing just a little better than that at 0.75%. So we got Powell yesterday trying to change the narrative, walking back suggestions of a rate cut. It seems most analysts have agreed that while the Fed probably should raise again, they misjudged where neutral was at, right? That's neutral's a hypothetical, mythical creature. We don't know where neutral is. But their goal was to raise rates into a mildly restrictive territory beyond the neutral rate. But if you don't know where neutral is, how do you know that you went far enough beyond neutral to be mildly restrictive or not? So at this point, it seems that they missed that a little bit and they paused probably a little early, and that it would benefit them to do another hike, one more hike. But most analysts agree at this point that hiking even just one more time at this point after having paused would probably cause a lot of banks some dire grief, and they'd probably break things. So it seems the consensus at this point is we'll just continue to hold here. It is restrictive, even if it isn't as restrictive as they wanted it, and that it will eventually do its job. I guess one analogy to this would be feathering the brake really light, right? You can stomp on the brake and you can stop really fast, or you can just feather the brake and ease to a stop. Well, they're continuing to just apply that mild pressure to the brake, trying to ease things slowly. We'll see if they get a little assistance out of Japan, then that can change things around. We also have QRA May 1st. So May 1st is also FOMC. Just keep in mind that the sell-off we've been seeing isn't connected to a thing, right? Remember when Boeing had airplanes falling out of the sky, killing entire families of people? That was a situation. They had something that was broken that needed fixed. It was a thing that you could point to and say, there's something wrong with this aircraft. This sell-off in the market is from perception. It's a temper tantrum from market participants who want that cut. They didn't get the cut they wanted. They're not hearing what they want, and they're throwing a fit about it. Nothing has fundamentally changed over the last month and a half, 2 months. Just the anticipation of a cut or no cut, and that's it. So, this perception or behavior, this temper tantrum, can easily be diverted into something else, the next shiny object, which very likely is QRA. We have auctions today. We're not seeing it on Market Watch. And we have a couple of Fed speakers today. The 20-year auction is today. I do like the 20-year. Yeah, it doesn't show the 20-year as being a very big deal, mild on its impact rating, but this is kind of a big deal. So you're definitely going to want to watch the clock today. It's 1 o'clock. And we get beige book. There's going to be some European central bank speakers, and they're going to do some data revisions. We could see the market kind of get a little violent earlier in the morning. The revisions come in. I thought it was at 11, but I don't know. Some point today, we'll have to hunt it down, and it's not the worst thing that we're getting today. But you can see how we got a lot, Bank of England and European Central Bank, a lot of speakers from that side. And even at 1 o'clock, we got Christine Lagarde. She's like the Europe version of Powell, right? Only she's sharper. Powell always reminds me of one of the Three Stooges, and she seems to be a bit sharper than that. When we have this many Fed speakers spread out through the entire day, there's a lot of times where the market will just be a lot of choppy, sideways, nasty, not really giving us a consistent move in a single direction. And after the hurry up and wait scenario yesterday, where we kept waiting on Powell all day, and we finally got him, and he caused a little bit of volatility, and that was it. The market went right back into sideways mode. That was a tell there yesterday. That was a bit of a heads up that we weren't just waiting on Powell. If we were only waiting on Powell, then after he was done, we would have broke this range or this zone, and we would have took off. Instead, the market was still waiting on something. We're still waiting on it, whatever it is. And they're not hedging it out. Don't know. So we want to get that auction today. See what's going on with the 20-year. The Fed speakers really are not expected to say anything more than what Powell has already said, that they're in a mildly restrictive territory, and they think they're in a good spot, and they're just going to hold the line. He's already done the job of walking back the rate cuts. So it's not like any of the other Fed speakers are, going to really shake the boat at this point. We've got lighter volume than yesterday, but still heavier than what we've seen for a long time when it comes to the mornings this past week or so, sitting in, the 130s and the 180s. That's a pretty good number we haven't seen for quite a while. But we are continuing to hold this low, building a base here. Now, I contend that all of this is just a reasonably decent pullback, and that 5 or 7% is about what we could expect. We won't expect really much more than that. So we're close to that 5%. There's 4.83 right there in the last 3 weeks. If we continue this move to the downside, we get into the 20-week moving average. That would put us at about 6.25. That's just about right. 5 to 7% pullback is perfect. If we get beyond that and continue to sell off, then we got to start reconsidering, some bear market metrics. A lot of analysts like to use 10% from the highs as a pullback. That seems a little tight, but it's more of a consensus concept than anything else, and it's a bit arbitrary. right? It's just be able to label a market as being in bearish territory because of how far it pulled back. When if you're using technical analysis and laying out how we got to that level, setting lower highs and lower lows and, breaking structure, kind of put you up into what price is doing, trending lower, trending higher, having broken a higher trend, but not yet trending lower. Those concepts are probably more valuable than just a rubber stamp label of saying, well, we pulled back more than 10%. We're, quote, in bearish territory. This all should line up really well with QRA and FOMC March, May 1st. So holding the line like we're doing, maybe easing down a little bit at a time, right? They don't want to just completely crash and burn this market and scare everybody. They want to just ease things back. Got an example back here, right? When we pulled back from high point to low point into the QRA of November. And we've been on a tear since then. But these pullbacks are just that. They're just a pullback. Then we get a change in data, change in perspective. We kind of need these pullbacks for the market to stay healthy. So we still have last week's level drawn out. 52.17 is the halfback we want to keep our eye on. 51.50 is last week's low. It lines up really close with the 10-week moving average. So it just kind of keeps some perspective, right? Especially you swing traders don't want to load the boat with a bunch of shorts. Nothing wrong with being short right now. Just, kind of keep in mind that we're not likely to continue to be short all the way down to like the 50. I think we would have to get some really serious changes in data for us to break below the 20-week with conviction and continue to move towards that 50-week. I think that would take a lot more negative market conditions than what we have now. So we are still inside day. That sets us up really nice. All we have to do is break out of the range. We broke through the low end of the range early this morning, but it was at the kill zone. We popped right back up again. So inside day breakout failed to the downside. They really stepped in and defended that low. That white line down there is a voodoo line called snow. Now we're focused on an inside day breakout off of the top side, which was heavily defended yesterday when we went up into that area. That is a voodoo line at 51.18. It's one of the minor ones. I think it's Forest. I'm not for sure. I think it's Forest. Still, inside day breakout would put us into the ADR half red line, 51.25. That would put us back into the 10-week moving average. If we get through that, we've got a voodoo line, the previous week's low, because right now we're inside week breakout, and then into the upper ADR. We've got a lot of resistance overhead. We got a lot of things over our head that's going to cause us grief. We also have zero gamma and the volatility trigger over our head. Now, they were talking on the founder's note, which right now we still don't have the AM edition. Yesterday, they didn't release the AM edition until after 7 o'clock. So some mornings it's just late, really late. They haven't released the AM edition yet, but they were talking about the SPX and how we're in backwardation within the options environment. That's a nice heads up. And of course, they had a little bit of fun with Powell here. If you didn't read the founder's note, it's worth taking a look, kind of getting a little perspective on the call wall and the options levels that are getting rolled around and moved. And of course, when I get the AM, I'll send it out. but we are in backwardation, so that's something to take a look at. We are also on OPEX. It's the third Friday of the month, which is always an OPEX, the 19th. Ten-day, 30-minute volume profile. We have the TPO in blue and the volume profile in green. So we're building a lot of structure here. If we don't break lower and we continue to hold in this low zone, it's very likely we're going to bring the point of control to us. We don't really have to hold here much longer. And it's not because of us holding here that would bring the point of control down. It's the fact that we're going to lose this bit of price. For every new candle we get on the right, we lose one on the left, and that's where the point of control is. So throughout the day today, we're going to lose more of these candles, which is going to lower this volume. And as that lowers, some of these others are going to look better. It's very likely that the point of control will be around this 5,200 by tomorrow, because I doubt that we're going to get enough volume through the rest of the day today to bring it all the way down to our current location. But we are going to see a stepping down in that point of control. That'll bring us 50 points closer to it without having moved at all. And later in the week, by next week, unless we come back up and change the way the top of this profile looks, we'll cut off this back end here and tighten things up even more. Five-day, 5-minute chart. I call this mapping out the 5x5. Still have a TPO in blue. Unfortunately, it's only looking at the current market. It's not looking back at these previous days. It can do everything that the regular volume profile can do. I just keep it set to the front so that we have the distinction of the two different ones. But we want to look for the VPOC. There isn't one. Where the point of control was at yesterday, we've cut through that zone multiple times, so we just don't have a VPOC here. It's not a surprise. It looks exactly like it did yesterday. Nothing's really changed on that. If we break lower, we still have a VPOC around 49.75 area and to the upside at 5,300. Markets going sideways like this, we learned from the RSI Laguerre about how markets gain energy and then how that energy is spent or how it's used. And we learned a lot about a sideways market like this, that it's building up energy. So there's always the healing discussion. A lot of technical analysts will talk about after a big move, seeing a market consolidate and base like this or build a topping pattern if we were at the highs. And how it's healthy, it's good, kind of brings structure back to the market. And they're not wrong in any of that. But until the RSI Laguerre, we didn't really associate energy with this, just the healing properties and the fact that it's good to have a market base and consolidate and kind of regroup. But this is winding up a lot of energy, make no mistake about it. Now you can visualize a phone with a battery at full charge, or a car with a full tank of gas. Doesn't really matter, whatever kind of energy you want to visualize there. But once it's topped out, you're really not going to get more out of it. It's got all that it can get. There's only so much energy that you can get. So then what's it going to do with it? Coming out of this sideways base, this range, very likely is going to come with energy behind it. Now, depending on the time frame we're looking at this, we could apply Bollinger Bands and squeeze, metrics like that that could show us that volatility is compressing and that we've got a market building up energy through that concept. That's not new. It's been around for a good 20 plus years. There's concepts like the IX10 or inside days, inside bar. So this is not a revolutionary idea, but this is a very tight zone. It's about 40 or 50 points on the ES. And we need to get out of this box. So it's very likely that the longer we stay in this, the more choppy and the more violent it's going to be. And it's very likely that we'll start to megaphone out of this. And that comes from the fact that liquidity resides on the other side of the pivot. So when we get to the top, we expect to go through the top into the other side of that because that's where liquidity is at. Same thing with the bottom. This was the bottom and we went through it because liquidity was on the other side of that bottom. Now we have a new bottom. If we get back down there, we're very likely going to go through it because liquidity is on the other side of the pivot. What begins to happen at that point is we start building out a megaphone, getting wider and wider and wider in our moves until finally we make the move and we leg into the next area, higher or lower. None of this is a bias of direction. It's not giving us long or short. The way that I tend to play this is short the high and buy the low, not sell the low and not buy the high. The good thing about that is if you're wrong, it's a small loss because it's an LRE entry and you just take the other side. At some point, we're going to come out of this range. So if you thought yesterday was hard to trade and violent and difficult, today is not expected to be any better unless or until we get out of this zone. All right, so we are at the year-to-date VWAP 2. This is an anchored VWAP from the start of the year. We're also on the weekly expected move edge. And this edge is drawn by an indicator developed by Mobius. I've mentioned this from time to time because the edge that you draw by hand, if you were to go and get the numbers, are more accurate than the one drawn by this indicator. Just the indicator is more user-friendly. You don't have to go in and catch that data on Friday afternoon or sometime over the weekend. And we can jump into different markets and look at things that we normally wouldn't look at, say like Apple or Meta or something, whatever. It's just very convenient to use this indicator, but it's not as accurate as hand drawing the lines, which is why you never want to focus on exactly right where that line is. Because if we had drawn it by hand, it might have been 3 points lower. It might have been 3 points higher. It doesn't really matter exactly where the line is. It matters that this zone is where the low is for the week. That's the entire weekly expected move. So don't get hung up on exactly where that line is. Also, it'll never be 100% accurate either because this number changes based on who your broker is. This implied volatility average that we use is a math formula, and every broker uses a different formula. It's proprietary. They don't share it. We know some of how this number is developed because it's just common sense and common knowledge of what they have to have in there, like time. We know time is in it. based on how much time is left here on the left, right? So we know that that number is in there. We know volatility is in there. We know some of the ingredients of that math, but we don't know all of the ingredients. And the broker's numbers here on the side, Thinkorswim doesn't look like Tasty. Tasty doesn't look like IBKR. IBKR doesn't look like Schwab, right? So it's never going to be some exacting perfect number that we can point to and say that's the weekly low right at this exact spot. So don't get hung up on where the lines are up or down to a tick or to a penny. And this conversation comes from somebody who said, how can the ES low be at a spot where it's not on a tick, right? The ES moves in tick sizes of a quarter, and we'll see it at 21 and 79, and it's not an exact number. Of course not. It's just math. It's a zone range. Don't get too hung up on it. We close inside this box on the ES 80% of the time. Now, this is a 1 standard deviation move, which means we're only supposed to close inside the box 69 point blah, blah, blah. Everybody just says 70%. That's close enough. But the S&P is so amazingly accurate, which is really just comes from liquidity, that it has a history of closing in the box 80% of the time, which is fantastic. I mean, that's an absolutely amazing number. So the easiest way to tell, are we slipping, is just to count back 10 weeks. How many times on Friday afternoon did the market close outside of this box in the last 10 weeks? If there's more than 2 incidents, then we're not carrying that 80%. And the markets are extremely efficient and accurate a lot. So, we'll maintain that 80% for a long time. But when things start to slip, it's usually a warning that things are getting a little wild out there. We'll close outside the box more and more often. The last time we did this count, it was at 50-50. In the 10 weeks that I counted, we were outside the box on Friday afternoon 5 out of those 10 weeks. That's a coin toss, man. We can do better flipping a quarter than trying to use this box to gauge whether or not we're going to be inside or outside of it by the end of the week. So, accuracy goes out the window, or, accountability is staying inside the box. If volatility continues to increase, we will continue to close outside of the box at the end of the week more and more often until something breaks and volatility starts to settle back down again. So last week, we closed outside the box, for an example. Friday at the close, we were out of the box. That would be one that you would want to count and then just keep working your way back over the last 10 weeks. Now that we have the 10-week over our head, that's going to be a major data point we want to focus on. No rally is going to be sustainable unless or until we can get back above that 10-week and really leave it behind. Waking up, cutting up through it, closing back down below it, that's just not good enough. We need clear and convincing evidence that we're sustaining above the 10. So now that we're below it, we want to keep track of the previous examples where we've been below the 10, when those turning points came, and what is our average usual turning point from the 10. What does extreme look like? Well, way back in that bear market, 2022, extreme was 7.5 to 8% below the 10-week. That's pretty extreme, but we're not expecting anything like that. It's more likely that we're going to see 1.5 to 2.5% below the 10-week. That's really useful when considering, some automatic programs, some mechanical trading systems. The thing about the iron condor, at least from the concept of the old one that we used to do, the weekly iron condor, is the size of the box. So one, we want the accuracy for the iron condor, right? Which is why the ES is such a great target to do that on. Knowing that your iron condor has an 80% win rate is pretty awesome. But if we're breaking outside of the box too often, and that lowers our iron condor win rate compared to how many times we're closing outside the box. So then we're looking at a 50%, 40%, however bad it gets. But even if we are running at an 80% in the current environment, we still don't want to do them. And that's because the boxes are still too wide. They've been too wide since COVID. And the easiest way to demonstrate that is just to draw a box around the week. You can just choose any of these. No reason to be particular about it. This is the range for the week. Take that range to a week before COVID. Doesn't matter which week you use, just go pre-COVID with that box, just drag it with you and move it on the chart. Take it all the way back to what price looked like before COVID hit. And you'll notice that this box is 2.5 to 3 times bigger than the ranges back then. So if you are building your iron condor using these lines and you're putting your call spread, with the center point on the green line or even higher, and you're putting your put spread at the red line or lower, your iron condor is so far out of the money that you're getting nearly no money for it. 8 pennies, 10 pennies. So then people argue, well, I mean, I'll take a 10 penny win if it can win 99% of the time. Yeah, but you're not winning 99% of the time. You're winning maybe 50% of the time or even 80% of the time. And if you win 80% of the time, risking 90 cents to make 10, it's not enough money for the time that you lose. It's not enough. You would have to win more than that. And then a lot of people use 50% profit. They close the iron condor early. So instead of getting 10 cents, you're getting 5 cents. You're risking 90 cents to make 5 cents. You have to have a win rate greater than 80% to make that profitable. It's too wide. So I continue to watch to see if these ranges are going to get narrower or if the amount of money that they'll give us for the range will go up, because that would solve the problem too, right? We need a narrower range or we need more money. And so far, that strategy still just is not effective as is. Instead, what you can do, still using these ranges, is do something like a double iron condor, right? I've got a strategy on it. If you look up the Marcus trade, you should be able to find it. We use like a double calendar. And what that'll give you is a chance to widen the range like an iron condor even wider and get more money out of it too while you're at it. So it reduces your risk, increases your profit, and it's just a win-win all the way around. It's the Marcus strategy. All right, things that are down this morning: nat gas, semiconductors, but really that scratch that. Semiconductors are basically flat. Nat gas is really the only thing down, and the VIX is down. But with the settlement period, the VIX had expiration. That's very likely going to throw this off. If you're doing anything with the VIX, especially around these settlement periods, try to see where the real at the money is. So just here we've got the VIX. We can go 27 days out at the money, showing right around 17, between 17 and 18. Makes sense because that's where price is, 18. But that's not really where the money is. To identify that, go to the VIX futures. You need the one for 28 days out. Looks like we're sitting at 1725. Not 18. Now that one, they're not far off, right? But you can find them a lot farther off, especially if you're looking at options that are 90 days out. You want to go to the VIX futures that are 90 days out. That's at $18. So VIX with its expiration going to be a little off. A lot of times you'll find a gap. Just some screwy charting. But nat gas is down, and things that are up, gold miners, a little bit of a reflexive bounce. Airlines, which I was surprised to see, they started coming around yesterday. This seems to be a continuation of. Metals and mining, which were down yesterday, and solar. It's interesting to see solar up this morning, unless we're getting yields down. Yeah, and yields aren't down. So that's a little weird. So what we don't see here is things like the Mag 7. They're right on the line, 0.5%. We want to see more of that. Now, just from the consideration of a rally day, a day, not, like swing trades, taking it back to the highs kind of stuff. Just for a day trade, we have the capacity right now to hold the line. This isn't looking very exciting. It could stop us from going lower, but it doesn't really give the confidence of going higher, coming up out of this base that we've built and breaking out to the upside. But it still seems like the market is waiting on something. And until we know what that answer is, what are we waiting on? Then we're going to anticipate that megaphone pattern. We'll continue to expect the market to overshoot the previous pivot point, go up a little bit higher, go down a little bit lower, continue to widen that spread out until we get whatever data it is that we're looking for, and we make the real move. So far, we haven't got that real move yet. None of these would be it. Now, it could be this PCE, but we're talking 2 weeks from now. And that just so close to the QRA of May 1st and FOMC of May 1st that this market isn't going to run sideways for another week and a half, waiting on something that far out. It just won't do it. It's very likely going to be from outside the US. All right, so the range is set. We just got to get out of that range, get a good solid break above, or break below. No bias in that, whichever direction we happen to cut. If we do break this low, that put wall is the target. I don't see anything that'll really slow us down or help us out till we get there. Then we'll at least have the options help at that point, which is really close to the ADR full anyways. And for the upside, there's just so much trash overhead that any move to the upside is going to have to come with some really great news, or it's likely to just be a slog and a fight to get through each one of those levels on the way back up. There's nothing really standing out this morning on the sectors. There was some news on pot stocks the other day, but we didn't really get much follow through on it. So nat gas is down, cloud computing, energy exploration, some crude if we're looking at USO, semiconductors, but they're not down enough. They need to be down a little bit more. Hot stocks are leading the way with airlines or jets behind that. You don't want an S&P NASDAQ rally based on pot stocks and jets. That's not what you want, right? We want consumer discretionary and technology, the Mag 7. We want those guys leading. So this expanded tech looks good, but it almost always just presents as a little dash. There's no real flows behind it. That's not helpful this morning. Tend to ignore that one. Got the building sector with a really nice red to green this morning. That looks good, but that fits the same thing as pot stocks and airlines. You don't want to rally on building materials. So then we got gold miners, silver, more pot stocks, uranium, energy. There's solar, it's uranium, it's crude, and airlines, which is odd. Usually if we're getting elevated crude prices, then the airlines suffer for it, right? They got to pay higher prices for fuel. They tend to not perform so well in the stock. So it's a little odd to see both of those up, but it's all energy. All the different types of energy is up this morning. And then the precious metals again with gold, silver, gold miners, financials. Yeah, they're not quite up enough to meet our conditions. Same with emerging markets. We don't see China up there. Like KWEB, it's all the way down here. We don't have the bonds up this morning. They're still down here. Shy, TLT. So keep our eye on the 10-year, whether you're using, TNX and TLT. Those two work really well. The Dixie, DXY, US dollar Japan. We want to see the 10-year fade off away from these highs. We don't really want to see it move to the downside really fast. That would shake things up. Just a gentle move down without a lot of extreme moves would be good. Same thing with the Dixie. Want to see nice, clean, gentle moves to the downside. No extreme, violent sell-offs. So far, the dollar managed to not have an inside day breakout. We came down and tested that low, and it held this time. But if we can break that low, continue to expand lower, and get the 10-year to break this low and get to the downside, we could see, reasonable beginning of a rally back up, maybe get back above the 10 on the S&P and the NASDAQ. But something is off. This is a market waiting on something. Everybody be careful. Be safe. I'll see you all tomorrow.